Cash flow, which is the movement of money into or out of a business, not only enables the business to support its operations, but it also fuels the growth of the business. Free cash flow, or the cash that's available once all cash expenses and taxes have been deducted, enable the business to enhance shareholders' value through acquisitions and the development of new products and markets. It also ensures that the business has sufficient funds to pay dividends to its shareholders. For those reasons, as well as others, the amount of cash a business has at its disposal is a consideration for long-term value investors. Discounted cash flow, or DCF, is a valuation metric used by investors, which is one of the sources of capital for a large business, to gauge the attractiveness of an investment opportunity. Most people accept that money loses value over time, which is a particularly important consideration for value investors who buy and hold long-term investors. It's a fact that next year's $100 will be worth less than this year's $100. The value the investor will apply to a DCF analysis to projected cash flows, perhaps over 5 years or more, allow them to arrive at the net current worth of these projected cash flows. In this instance, the investor wants to estimate how much free cash flow a company will generate over the next 5 years. To make these calculations, it is necessary to forecast the company's revenues over that period. Once these numbers have been estimated, the investor must then estimate and deduct the company's operating costs. Investors should consider using the discount cash flow or DCF method to estimate absolute value of a company. Financial ratios as well as multiples provide a quick and easy way for investors to determine the general value of a stock compared to other investments in the market. But how do we go about estimating the value of that company? That's when discounted cash flow, or DCF, can come in handy. Valuation methods based on discounted cash flow models determine stock prices in a different and more robust way. DCF models estimate what the entire company is worth. Comparing this estimate or intrinsic value with the stock's current market price allows for much more of an apples-to-apples comparison. For example, if you estimate that a stock is worth £20 based on a DCF model and it's currently trading at £10, you'll know that it's undervalued. Estimating a stock's fair value or intrinsic value is no easy task. In fact, it's actually quite complex and involving all kinds of variables that are themselves tough to estimate. Despite their complexity, valuations based on DCF models are much more flexible than any other individual ratio, and they allow an investor to incorporate assumptions about such factors as a company's growth prospects, whether its profit margins are likely to expand or contract, and how risky the company is in general.